Well, good morning, everyone. Welcome to the Experian Quarterly Business Credit Review for Q1 2025. I'm Gary Stockton. I work here in marketing at Experian with Brody. Before we get underway, I'll touch on just a couple of items. If you would like to follow along or maybe view our slides at your own pace, we have dropped a PDF of the slides in the handouts area, and you can just hit that QR code or go to the short link. We'll also include a link to the slides in our follow-up emails. During today's webinar, we will be discussing key findings from the latest Experian Main Street Report for Q1 2025. You should all be receiving an email from Experian announcing the release of the latest report today. Our follow-up will include it if you do not already have a copy of the latest report. Our presenter today is Brody Oldham, VP of Commercial Data Science. Brody leads a team of experts who help businesses make sense of complex data. His team analyzes market trends, builds predictive models, and creates clear data visualizations that help companies make smarter decisions. He specializes in using data to solve real-world business challenges, from understanding credit risk to spotting new market opportunities. Brody also shares his insights as a speaker and writer, helping business leaders stay ahead of shifts in the credit market. While we're presenting, we would love to receive questions, so just hit the Q&A applet in the tool panel. We'll answer those at the end if time permits. If not, we will certainly be in touch with answers to you directly. We want it to be very interactive, and we'll ask for your comments after voting in polls. Now I'd like to turn things over to Brody Oldham for today's review. Brody?
All right, thanks, Gary. And thank you all for joining today on this very nice midweek hump day presentation. We're excited to have you with us, and we're excited to talk about some of the trends that are moving this nation and really guiding the way that the world is operating. And we're going to talk about a few of the opportunities that you'll have to engage markets from a small business perspective. We'll talk about consumer spend and how that will drive small business growth over the next year. I'll sprinkle in a few things about how it's impacting just me and our business here at Experian, as well as look for opportunities for you to engage us and tell us how you're feeling about some of the key indicators that are ticking up, creating some flags around us, as well as what's driving you to make certain business decisions. So we'll have some poll questions throughout. So like Gary was doing, I want you to make sure that you have your mouse ready and that you're ready to engage us. Remember, you can always put questions in the chat. Gary will jump in and signal me that we have a question, and we'll try to answer them as we go through. If we don't get an opportunity to get to your question, we'll certainly reach out to you with an email after and respond, give you a little of our insight. And if there's anything that we can do for you or help you with your business, let us know. We're here to do that. So we'll jump right in from a U.S. market perspective, look at the growth that we're seeing here stateside. It's always exciting. We've had a first quarter that was started off very strong, ready to go. The excitement from December to January was palpable. We really had the excitement and really optimism that a small business owner really wants to see. We saw our tick up in the NFIB survey, where small businesses were just on the edge, waiting for a green light to expand and grow their businesses into this year. As we got into February and March, we looked for some volatility that came through as we looked at potentials of new expansion and tax relief and regulatory relief. We saw that through some of the DOGE activities, as well as some of the activities that we saw from a policy perspective and executive order. Now there was some positive tailwinds that were coming from that from a small business perspective. Now what was a little more challenging as we got into our April timeframes, a couple days in the first 2 weeks of April, as you know, some tariff activity, policy around tariffs, not necessarily tariffs all going into effect. Now we did have a 10% flat tariff that went into effect, but in general, those heightened tariffs have been a little hit and miss as far as what actually went into fruition. What that caused is some pullback, a little bit of slow growth. So with the volatility that we saw in the first quarter, we're going to talk about some of the things that we saw from ordering activity all the way through to small business performance. And I think some are intuitive and some are a little counterintuitive for what you might expect. So I want you to hold on and get ready as we go through the next 40 minutes or so to what you'll see and what might surprise you, but also what might confirm some of your thoughts. And as you go back to your business and try to raise up for some of the activities that you'll do through this year, hopefully some of the insights that we provide today will guide you and help you as you go forward. But you can see here on the left, we saw some slowness in the first quarter from a GDP perspective, down a little bit, about 0.3%. You can see some of the factors that leaned into that lower percentage rate. Again, not in recession. This is just a pullback, slowdown as we go forward. But there are a few things that play into this. Some of the challenges that you see are exports. That's the big one, down 4.5%, almost 5%, really pulling down on GDP as we were going forward. Housing, you'll see, is a little bit up. That's that light blue one at 0.5. So as we go forward, you're going to see some of those that are a little counterintuitive. You might think housing is our big drag on GDP, but it's not actually at this point. Now, it's not the growth engine that we would like to see, but it is not really pulling us in a negative direction. So that's very positive to see over the past quarter. Federal spending is down. Of course it is, with a little bit of a slowdown from a government engagement perspective. There were some holdups in projects that we saw from the federal government to some of our small businesses. Contracts held up a little bit. So spending was down and that pulled back again. We may see that roll into this summer and some of those get kicked back up. And so we should see some tailwinds here from a GDP perspective that'll help push us forward. But there will be some headwinds as we get into the next couple months. And you can see from a GDP perspective that we are seeing some pullback from a growth perspective in the far right. So we're going to watch that as we go forward. It's something that's keen in our vision and a big focus as we go forward to try to help our small businesses find opportunity and funding. All right, let's go to the next slide. So let's talk about some of those big things that are happening internationally and domestically. You can see a few of those listed here. Of course, infrastructure funding is a big one. We've had some of the things that you'll notice if you're an SBA lender, a Small Business Administration lender, you'll see that some of the requirements around what can be put through quickly for Premier members has tightened up a bit. Some of the programs have even stopped as the money that's being allowed to be lent out is a little bit lower than it was originally. But I think as we go forward, we may see some of that open back up as the economy kind of catches its rebound here heading into the end of the year. Regulatory changes, certainly from a CFPB perspective, a lot of the rules that were put out by 𝘄PRA toward the end of the year have been rescinded. Some of those are still being reviewed, but the actual rollout of a lot of the rules have been slowed, and that allows some of our larger lenders who are lending into the small businesses be able to free up some capital, move forward with some of the lending activities that they may have been holding back on as we're coming into the fourth quarter of last year. Trade policies and tariffs certainly impact us. We're going to watch that, but it seems like if we look across that we're getting a little bit of relief even through the weekend. Seems like our government works all the time, 24/7 now, and so we get a lot of that feedback. We're going to look at some of the numbers on that. Energy policy shifts. From an AI perspective, remember DeepSeek came out last year and said, hey, we can do it a lot more efficiently. What did that cause from a utilities perspective? Well, utilities were ramping up. They were getting excited to be able to support big data centers. That meant a big pull from energy companies. That means opportunity for investment. When we saw some of that efficiency really come out, big pullback from a utility perspective, you'll see some spikes as we go through the numbers for utilities where delinquencies are really high toward the end of last year. But then those were called back, and so we saw some good recovery from that slowdown as some of our big Tech 7 in the industry leaned back into investment in data centers. You're going to see a lot more of that this year. That investment continues, so it's not even though it was a little bit of a pullback as the companies were assessing what the impact would be of the new trends in technology, they continue to move forward with some of their investment from a data center perspective. So some of these that are in are from a commercial construction perspective as well as energy, you'll see some pick back up. And you know, we always laugh. I heard it mentioned even this morning, hey, what's going to happen next with NVIDIA tonight? Are they going to say, hey, we've bought Chevron, now we have our energy source, and we could move forward and build all of this cool new tech? Who knows what they'll come out with tonight? We're going to watch NVIDIA as they talk about their performance at the end of the day today. But of course, they're a big player and a big mover that we've seen over the past couple of years. Big shifts, certainly in the past 24 months. So we're going to watch them as well. Labor and immigration always pops up too. So as we're seeing more pressure on migrant workers, as we see immigration policy change, become a little bit more structured, what we'll see are some of our hospitality, construction, a lot of those kind of fringe types of jobs will start to be impacted as far as labor force migration. And so a little more challenging to get the type of labor that is needed to manage, certainly from an agricultural perspective, being able to bring in fruits and vegetables, other types of products from food source generation. We'll see that have some impact, and we should see costs go up just a little bit from a food perspective as we go forward. So we're watching that certainly as we get into this next year. Now, what's one thing that we want to look at? I told you we'd look at some tariff numbers, and on this next slide, we're going to look at where this really came into play over the last year. So you can see the US effective tariff rate really shot up as we got into the first part of this year. It's a pretty significant jump. And you can see that goes back to the 80s and 90s, where we really saw tariff rates at this high of a level back in the 1900s. And I said 90s, I wasn't thinking correctly. It wasn't really the 80s and 90s, back in the early 1900s, when we're talking about around World War II time frame. You saw some of those kind of pick back up. And so that was really a challenge that we saw. They've really been pulling back. We've tried to create more of a free market open, but as we've gone through the past couple of years, we've seen some trade imbalance. And so bringing the tariffs back in really is a bargaining tool for the new administration. Whether they will stick at their higher levels, we've seen China and the US come to the negotiating table a week and a half ago, and be at 2 weeks now, and bring back in, come from 145% down to about 30%, which was significantly less than what we expected it to be. We really expected it to be between 50 and 60% from a tariff perspective, but really down a lot lower than even we expected. Now remember, that's only going to be for the next 90 days. So toward the end of the summer, we'll see this spin back up again as the two countries come to the bargaining table, negotiating table, and try to work things out. You're going to see that from several countries that are in the negotiating pool right now, looking at their tariff activities. So supply chains will be impacted over the next 90 days as companies are looking for different routes, trying to identify places where they can move some of their production of key resources, widgets, if you will, to bring back into the country to have them put together here in the US or in our Canada, Mexico, with those trading partners, bringing it together more closer to home, more domestic type of production. Now, as we look at the consumer price index, we really can see some inflationary pressure coming in as tariffs go up. We're going to talk about what kind of pressure that could add. All right, Gary, let's hit I hope you guys all have your hand on your mouse. Let's hit our first poll question. So when you think about tariffs, how are you going to handle it? Are you going to split the cost with your supplier? Are you really thinking pushing that back on the supplier? I think Walmart looked at that to keep savings low or to keep savings high, as they're the value provider. Are you going to absorb the cost? Or are you going to pass it on to your customers? So something to think about as we go forward. We've seen just a mixed bag here from a lot of our small business small businesses across different industries. So I want to see what this group, how you guys feel about how inflation will impact your engagement with your customers. How are we doing, Gary?
Doing good. We got about 36%, 37% voted.
All right, keep those hands on your mouse here. I think this is an important one. You guys will all have an opportunity to learn from your colleagues where they're positioning. And I think it's important for us to just take a look at, we've seen it across VW, passing it on, putting it on the stickers for their cars, holding ships back, trying to determine when they would put forward and be able to move that on. We have other customers looking at their margins and saying, all right, is this going to create too much margin compression for us? And are we going to be able to really continue to operate if we were to absorb these types of costs? All right, Gary, what does this group think?
All right.
Look at that. All right, so not as many absorbing the cost themselves. So of this group, splitting the cost or having the supplier take on a lot of that cost burden. We've certainly seen that with a lot of companies interacting with Chinese partners, pushing back on those. Passing it on to customers, 61% is really a majority here as we go forward. We're going to talk about where consumers are and where small businesses are as part of their ability to take on some of these additional costs over the next 6-8 months. So let's move on to that, Gary, as we go forward, and we'll continue to look at some of the macro trends that we see out there. Now, one of the things that plays into affordability is certainly an interest rate as we look out, and then the 10-year Treasury certainly sets that bar for businesses as they look for an opportunity to set the rates. Certainly from a mortgage perspective, or if you're looking at from a credit card perspective, where do we kind of set the rate plus? And so what we can see from a federal funds perspective is that the federal funds rate has been elevated. It started to come down. Our expectation is that we will see it come down a little bit more this year. We'll see some slowness through the summer, and that'll potentially encourage the Fed to make a cut or two as we get toward the end of the summer. That's our expectation here as we go forward. What you'll also notice is that across the bottom, how have the equity markets been doing? It's a little strange to see bond and equities in lockstep, but you can really see that there was a dip, certainly as tariff worries came into play. But a lot of investors are back in the markets, still investing, looking for opportunities through the volatility cycle. And we'll continue to see markets move up as we get into early summer. So we're continuing to watch that as we go forward. Seeing those investors still engaged, certainly from a US perspective, and US is still pretty stable here across the rest of the world, even though there's been some noise out there. The US has a very stable market as we go forward, and so we'll continue to see investment here in the US, a little bit abroad right now as we see some weakness in the dollar and other things, but I think some of that will come back as we get toward the end of the summer. That's 𝘀𝗵𝗂𝗋𝗻's opinion, not the opinion of Experian, but certainly looking forward as we watch the market transition. We'll continue to see some growth, and again, we'll see some inflation kind of tick up as we get a little further along. Gary, let's go to the next one. So let's look at the labor market. So if I'm a small business owner, I want to know how the labor market's performing, because the weaker it is, I might be able to get folks in my door and in seats at a little bit lower price. We still have a pretty strong labor market. You can see that over the past 2 months, we've had some reasonable gains, certainly from a job perspective. Our unemployment rate still around 4%, 4.2%. The expectation is that'll go up a little bit more toward the end of this year and continuing into 2026. But our base case is still around that 4%. As we go forward, you could see it grow a little bit more depending on what we see. If the tariffs stick and negotiations don't go through, we may see a little bit slower. If we see the budget kind of waggle a little bit from the House to the Senate and some of the changes that we see there, we may see the end of the summer be a little bit more volatile. So we're going to watch that certainly as businesses kind of lean into what's going to happen over the next year and preparing. Are we going to see some additional layoffs or changes in the resource mix across companies? So let's look at some of that on the next slide. So as we think about what's happening from a labor perspective, our hire rate's a little bit lower than it's been. That means the job market's a little bit weaker than when it was before. You can see that people moving from employment to unemployment, when we think about those that are unemployed, you really see that some of our white collar workers are a little more out of work, a little more challenged. The sentiment around getting a new job for the white collar segment, those with bachelor degrees and higher, is a little more challenged into this next year. Certainly with the really engagement from AI, from an efficiency challenge across businesses and global trading partners. As we look about global impacts, what we're seeing is really hitting the white collar first before it's hitting the line. So a little bit different than we'd seen in years past. So something for us to watch. Now, we talked about Doge a little bit at the very beginning. And originally, you see some big numbers that came out of some of the efficiency activities that were happening across different agencies. What we really saw, and you can see some of that in the bottom left corner, is that it's really not a large percentage overall of the overall population that's being part of this government efficiency activity. Where we see it mostly is in District of Columbia. Across the rest of the nation, when we look state by state, we're really seeing less than 1% really coming in. Now, California has a few more. You'll see a few states that have a little bit higher percentage, but in general, we shouldn't see much impact to the overall unemployment numbers as we see some of these activities continue throughout early summer. So something that we were a little bit more worried about in the first quarter, now we're not as worried because we've seen some of the pullbacks, some of the efficiencies not really going into place as forceful as was expected at the very beginning. And so we see less impact to the overall labor market. All right, Gary, why don't we run the next poll? So, are consumers out there spending? And how do you see it interacting with your business or with your customers? Do you see them spending more? Consumers spending about the same, a little bit less? Or are they asking for some forgiveness? So sometimes you'll have a consumer that is spending a little bit more, they're in over their head, and they're coming back saying, I'm overutilized, I can't pay my bill, am I coming back? So as you're looking at your customers, where would you classify them in these buckets? How are we doing, Gary?
Got about 50%.
Great. You guys kept your fingers on the mouse this time. That's fantastic. I'm excited to see how we come out, because I think this is really where we look for opportunity for small businesses, as we really see how consumers are engaging with us as we go forward. All right, Gary, let's take a look at the results.
Okay. It is how it feels.
Oh, look at that. So as far as our owners here, our lenders that are on the phone with us, spending a little bit less seems to be where we're at. And we're certainly going to talk about consumers and where they have been and where they are and some of the reasons why they're spending a little bit less. So when we go back to our slide before, what you're going to see is consumer sentiment has been in a downward trajectory. Small businesses have been following that from the Michigan survey. What we saw from the conference board this morning is a bounce back of about 12% on the conference board consumer survey, consumer sentiment. And the expectation there is that they're seeing some movement across. They're not seeing as much tariff impact to the bottom line. Some prices are edging up, but not significantly. So consumers are feeling a little bit better, certainly from the perspective of what their hard costs are. And then from an investment perspective, we've seen markets kind of gain back. So consumers, as we look at these sentiment, will slowly, the soft perspectives will start to catch back up. with the hard data, and we should see sentiment rebound here as equity markets kind of pick back up and you feel like you have a little bit of a cushion in your investment portfolio. Hopefully not all of you are looking at that, but if you are, it's been a wild ride over the past couple weeks. So let's look at some of the data that we see from a spending perspective. So when we think about consumer spend, what you'll notice here is the pink line dropping down below the dotted pink line. And what does that mean? That's disposable income. So those that are on, what kind of income do we have on the outskirts? We did see savings rates pick up at the beginning part of the year. You know, when you feel a little volatility in the market, you pull back on your spending a bit, you save a little bit more for a rainy day. Your expectation is that it's out there. You know, always think about it as a person that has an umbrella. They always carry it with them. They don't know if it's going to rain, but they certainly are expecting it to rain. So that's what we've seen. We've seen consumers looking at their disposable income, having a little bit of their savings. They're getting to the point, even though they're spending about what they were spending before, they're being a little more cautious, cost conscious in what they're spending. And you can see certainly from the expectations across the market here again, where people are feeling that they're going to be. And one of the things that I really want to point you to on the far right is the expectation, the expected change in financial situation. So here you can see college degrees. Remember we talked about white collar workers having a little bit more uncertainty in the job market coming from them. Remember, as we get into some of the higher income levels, they're really what is driving disposable income. If you have more worry in that upper income segment, you're going to have more challenge in the spending out for specialty products, things that are on the fringe, nice to haves, not needs. And so we certainly looked at that from a small business perspective. There are a lot of businesses that support from a disposable income perspective. So we're definitely watching that. Now, is that really hitting the bottom line at this point? I don't think so. We're just getting to the point where consumers, to keep at the level of spend that they're at, we really want to see wages continue to rise, and the wages are actually slowing. So we're seeing spend continue, but wages slow. That's going to get, again, like you all are saying, we're seeing a little bit less spend than we had seen over the past few months. All right, let's go to the next slide. All right, so we talked about spend. If they're spending and they don't have as much disposable income, where do they go for money? They come to creditors. They say, all right, I'd like to pick up a loan. So what are we seeing out there? How are creditors feeling as they're putting out unsecured loan products, as they're putting out term loan products? How does it look? Well, I would say that it's been pretty consistent. We haven't seen a lot of loan growth out there from an originations or capture perspective. It's been pretty steady, and you can see that in the top left corner. We have seen a little bit of an improvement in the mortgage market, which is good, a little bit of up and downs, and we'll talk about that a little more specifically. One of the things that we've seen lately that's been pretty high have been HELOC loans. They've really taken off. The difficulty with HELOC loans is you have to be a homeowner, and with a HELOC, you have to have equity in your home. And if you have that, it gives you a lot of opportunity to pull some cash out and have that cushion. The other thing that we've seen grow really from a provider perspective is fintechs. So as we see some of our big financial institutions tighten their credit criteria, we see fintechs kind of come in, create that smooth, flexible process with consumers, be able to pick up a little bit more of the market share. We've seen them on the rise. Now, again, they're a very small percentage of the overall lending ecosystem, but they've seen some good significant growth over the last 24 months. And that's really looking at young emerging consumers that are out there, people with not a lot of credit, thin file consumers getting the market. We're also going to see that with small businesses as well, those that are less than 24 months old. But from a consumer's perspective that we're looking at here, again, delinquency rates have leveled out a bit across all different products, which is good. We're seeing that the 30-day delinquencies have come down a little bit over the past couple months. Again, good. We continue to watch that. And, we talked about those higher income consumers and what they're feeling as we're getting into the summertime. I like to look at this bottom count. Joseph Mayans, our chief economist here at Experian, called this out for me, and I thought this was very interesting. So if you look at TSA numbers, people going through at the airport, are we higher or lower than we've been over the past couple months? And we're keeping that number a little bit more elevated, which is good, keeping it up. We're not dropping off. That means still spending on vacations and travel and business travel. So that's very positive as we go forward. Not seeing a pullback on that. If we saw that, that would be one of our key leading indicators to say, all right, that now we need to start really looking at some softness that we'll see over the next couple months. But those numbers have been still pretty respectable as we're getting into the summertime. So from a consumer financial health, still pretty good, pretty solid underneath with the fundamentals. All right, let's go to the next slide, Gary. All right, so one of the things that's going to hit us this year is already starting is student lending. And student loans have been out there, they've been back and forth, a lot of policy changes being put out and pulled back over the past few years here, and that's caused some really challenges for consumers knowing, is it time to pay, should I pay, am I back on, do I need to make a payment? I remember back when I was a little bit younger, I said, hey, if I could only make this amount, I could do a little bit more. And every time I made a little bit more, I seemed to spend a little bit more. So one of the challenges that we're having now is as we put a pause in student loan payments, you had people say, all right, I can spend a little bit more now. They spend a little bit more, they're consistent in their spending. Now we're going to add back in student loans. That's going to put them at risk of being a little bit under from their income to spend ratios, if you can say that. So a little bit more challenge for consumers. When we think about consumers, when we add this back on average, it's about a $600 payment that gets added back onto a person that has student loan debt. That's pretty significant. It's like a car payment that gets added back on. So we are seeing, you can see this spike back up at the first part of the year of 90-day delinquencies. You have to think about that as folks that aren't sure if they need to pay or not, and they're kind of getting caught in this repayment process, is getting back onto the platforms and making payments as they go forward. This does impact some credit scores. You're going to see that for both consumer and small business owners. For small business owners, as we've done evaluations across small business owners that have had student loan debt, they're using more of they can change or have a little bit more of a push with business, with their cash flows, to be able to pull a little bit more out into income, put that towards student loan debt. But it does have an impact on the growth potential of the small business as they go forward. So we are going to see a little bit of a slowdown caused by student loan debt being brought back on to consumers and small business owners as we get into this next year. But again, it's one of those where we look at what could come from policy and what could come, I say that with a little emphasis, from a policy perspective and tax extensions, tax relief, as well as some of the policy changes that are out there, certainly like things like no tax on tips will again bring in some additional value for our labor force and allow some additional cash to pay down some of this debt. But it is something that is lingering and that we're going to continue to watch as we get into the next 6 months and the policy continues to lean in for repayment. Now, repayment on student loans, remember, you can still garnish wages. This is not something that people can choose to pay or not pay. In some instances, that really does come immediately back into there as a cash flow impact. All right, let's go to the next slide, Gary. So we've talked about our consumers. Let's look at small businesses. So the growth in small businesses continued. You can see that in the top left. Remember, we thought after the pandemic, we had this big innovation spike. We looked at small businesses and they'd really been picking up. You can see that the numbers of applications have remained steady at about 450 to 500,000 a month. It's only 100 to 120,000 new businesses that are really starting every month that can go past about 5 years. But you are getting a lot more of these emerging companies that are entering the market. A lot of them are are less than 24 months old. What you're going to see in some of the numbers today is something a little different. So we're out more than 24 months from the pandemic. What does that mean? Well, that means that some of these companies that had that innovation spark right at the time of the pandemic are now more than 24 months old, and they have the ability to go out and get more stable at large financial institution, lower cost funding as they go forward. So an advantage, we're going to see that impact our origination and credit line numbers as we go forward. But what else you'll see here is the delinquency levels, like on the consumer side, they've really been headed in a downward trajectory since the summer of actually 2 years ago. You can see that from a 30-day perspective, that green line on the top in the top right. You'll see 60 days start to edge up. We don't see that inflection point yet, but it looks like it's heading that way. When we see the 60 days go above the 30 days, that means more of those 30 days, they're rolling into 60. We're not seeing that yet. Numbers are still low, but we're going to continue to watch that. You'll see the 90 days also picking up a bit. That happens. As our economy has been heating up, you'll see more of the 90 days kind of pick up, but it's been pretty level and not really accelerating from a 90-day perspective. So not rolling into 90 any more quickly than it has been over the past 2 years. Now, from a credit score perspective, somebody may say, all right, if delinquencies have gone up a little bit over the past couple years, are we seeing some utilization changes? Yeah, utilization has been going up. Has it crossed the 30%? No, not yet. And that's when a credit score really has some significant impact. So it's approaching 33%, not quite there yet. So we do see credit scores start to drop a little bit over time. As our economy heats up and we see more of those delinquencies and utilizations kind of hit. New companies are bringing on new credit cards, and if you've ever monitored your credit, your newer credit cards, sometimes it'll say, hey, this is a new debt that you're taking on, so your score comes down a little bit. And as that ages and you pay and more over time, your score continues to go up because it looks at it as good payment history. What we've noticed is the transportation industry is seeing our biggest decline here from a credit score perspective. They've been impacted from oil and gas perspective, from supply chain challenges. Getting a product in the back of trucks has been pretty difficult over the past 2 or 3 years, and so that's created some additional delinquency. And remember, all of that stimulus that came into the market from a trucking perspective, people went out and stopped working for trucking companies. Yellow went out of business. People bought their own rigs and went out and got on the road. If consumers slowed the amount of product that they could buy, they didn't need as many trucks. They didn't need as many containers. And so a lot of these individual independent truckers had real hard time, and they flipped over a lot of delinquency. And so you'll see scores in general for the transportation industry heading down a little bit more than the rest of the industry groups. From a regional perspective, again, most delinquencies from a 60 to 90-day perspective are coming down. We're seeing a little bit of increase in the last couple months here, but not significant velocity across. A little bit more in the West, and we can see that from a startup perspective, a few more startups from a tech perspective in the West, and then again, some port challenges that we're seeing. There we will see some delinquencies hit in the West, certainly as we're seeing some supply chain challenges, transportation, warehousing, as some of those are impacted, certainly in the Western region as we go forward. All right, let's go to our next slide. Talk a little bit more about small businesses. So, good time for a poll question. So, as we look at those last comments, and we think about small businesses, their growth, delinquencies coming down, what do you think? From a small business perspective, put yourself in the owner spot, have your founder card out and ready to go. Do you think are you ready to invest and grow at this point in the market? Are you thinking about cutting some costs, shrinking a little bit? Are you going to hunker down with what you currently have and kind of wait it out? Where would you be if you have your small business hat on, or where are you seeing your customers at this point, thinking about what they're going to do over the next 6 or 8 months? All right, Gary, hope everybody had their finger on their mouse here and putting in some good answers as we look at how the market is reacting to some of the small business numbers.
Just over 52% voted.
Great.
We can see a trend here in this vote.
I'm excited to see what it looks like.
All right. I think we should, we'll go ahead and we'll close it and share the results.
Hunker down. I always like the word hunker. It is kind of a funny word, but kind of settling into your place and saying, all right, we're going to wait and see. I hear a lot of the wait and see comments as we go forward. I think we're getting to the point now where we'll see in the next 30 days, some of the volatility will kind of be squished out as we go forward. I think there'll be some opportunity as we look for the budget to pass here in the next 60 days to see where spending will go, where our deficit will settle, what type of stimulus we'll see for small businesses continue over the next 6 months here. So I think we're really looking at the way that consumers will spend and customers will engage us from a small business perspective. Now, if you're going to think about you're hunkering down, are you going to be borrowing a lot of money? Well, at this point, borrowing's been pretty stable. We can see that across both card, unsecured, and term lending. You will see what I like to see here is the pink line in the top left, a little bit of change, a little bit slower on the term line side, but those lines from a card origination amount starting to pick back up. Again, these are the small businesses that are a little older than 24 months now, getting a little higher credit line. So that's certainly going to help from a lender perspective. If you're growing those portfolios, that's going to do a lot. Now, the other thing that you'll see across most of the industries is that we see from originations perspective, a little flat. You'll see transportation has been in a downward trend, but that's as you're tightening up credit criteria, that might not be the first place that you go. But you'll see some of the others pretty stable across originations. And as we go forward into this next few months, we'll be watching how small businesses interact with our products. And you can see on the right-hand side, the APRs. So from an unsecured perspective, APRs have been going up around 21% on average. That means that if you're a small business owner like me, you may look and say, all right, do I want to open up a credit card line at 21, 25, 26, 27% APR, or do I want to look at a term loan at 9 or 10%? So you can see the term lending side has picked up a little bit more than the unsecured from a small business perspective. But again, hunkering down, not borrowing as much. As we look at utilization from a small business perspective, again, we're seeing that actually pull back, not spending as much. We want to look for that this summer to see if it's going to level out, even pick back up a little bit more as prices pick back up a little bit. But as you talked about, are we going to pass on the cost, or are we going to hold that and have some margin compression there? If we're passing on the cost, then we may see that utilization open back up a little bit more and not as much compression or move up into the 33%. All right, let's go to the next slide, Greg. All right, so let's talk about some of the things that we're seeing across different industries. So non-intuitive wise, retail sales have been picking up a bit. In the first part of the year, we saw everybody go out and get their inventory before the tariffs came in. So you saw some good uptick here from a retail sales perspective. That meant logistic from an LMI perspective. The trucks were getting filled up. We had them costs go up a little bit from transportation perspective and shipping perspective. That's pulling back a little bit. We did see the Port of Los Angeles come down to about 3 ships. Cancellations on ships were, I'm trying to remember, I think it was 7 of 18 ships canceled or were holding at their origination point before they were taking off for the Port of Los Angeles. So a slow couple weeks here in the port, not moving as much product. And certainly the worries are out there for Christmas. Are we just going to see another wave of imports as we go forward? Or are we going to continue to see a slowdown at the ports? And I think as we saw the tariffs pull back a bit, we're going to see some movement here, certainly some positive movement into the ports over the next couple weeks. So let's go to the next slide, Gary. So I think we'll talk a little bit about retail. Let's talk about some of what we're seeing across the earnings reports. From a consumer spend perspective, just at like Dollar Tree, you know, when we think of these value providers, Dollar Tree, Walmart, TJ Maxx, all these are seeing some good value shopping, not as much on the high end, taking away from some of that discretionary spend, more focused on what's the value and looking for value adds. Now you'll see that across a lot of different companies. Target's a little bit more challenged. Home Depot and Lowe's had great earnings numbers coming in out of the first quarter. And so we still see people and small businesses shopping there. And again, it's a kind of a pull up saying, what are we going to look like through the rest of the summer? And again, these earnings are pretty solid, more solid than we really expected coming out of the first quarter. So that's good. And you'll see on the left-hand side, it's a little bit of a K-shape utilization rate spend. That's really where we're seeing low income, low moderate income zip codes having a little bit more utilization on their cards. Is what you would expect. Higher income zip codes a little bit lower utilization, but again, both are creeping up from a utilization perspective. So overall costs are leaning in a little harder, and so you'll have a little bit more utilization on your unsecured products as you go forward. All right, so good and solid. So let's look at a couple more industries here before we wrap it up. I think we've got next construction, because construction is one of those that we watch because it is a big industry in the US. We continue to see housing inventories at a low level, lower than really we'd like them to see, and certainly from a National Association of Realtors, we've seen them pretty low. New home sales are still pretty low. Costs are high, interest rates are high. We saw the 10-year higher. You see that gap there increasing, and so what's that's doing? That's keeping the rates higher than consumers would like to see them. It means they're not really out there shopping as much as they could. Now, the good part about a home equity loan is that if your equity's high, you pull money out of it, but you're not really moving the inventory around. It's not creating opportunities for home builders to really get out there and spark up a build opportunity. So we're going to continue to watch this as we go forward. But again, low inventory, low builds. You can see permits in the far right, lower than we'd like them to be, and on a downward trajectory, just slight. Home prices continue to go up, so a little more expensive, but less inventory. Makes sense. Hopefully we see that converge in the opposite direction as we go forward through the next year. But again, it's one of those that we see overall new originations from a construction company perspective, lower. A little bit of an uptick in the last couple months, but not really a high velocity move as we go forward. So we're going to continue to watch from a construction perspective, but we really need to see some of the materials, tariffs on materials get a little bit lower. We need to see rates come down a little bit more. That's what the administration is pressing the Fed. Fed's still independent, going to watch the numbers, not going to move as quickly. But I think that, again, that in between, we're kind of in that in-between phase of being really ready for the economy to take off and for the volatility to cool down a little bit. So we're going to watch that from a construction perspective. Now, what hasn't been really cool? Now, when we look across from an AI perspective, what you're going to see is a market that has been expanding. And some of you may have portfolios in the professional and scientific subcode or NAICS codes. If you're looking at those in those industries, what's been exciting over the past couple of years is we've really seen the expansion of large language models, chip production, the component production that goes in. There are some companies that do it really well and have been at the top of the game. We talked about it in NVIDIA at the beginning of the call, 90% market share, and they are still expected by the market to grow at 3-digit numbers, and really they're only going to hit lower 2 digits. I mean, 19-20% for some of us, that would be a phenomenal year. But you think NVIDIA with 90% market share, it's hard to grow that much, especially with some of the barriers that they're seeing from a tech perspective across all these tech companies being able to sell into some of the larger markets like China as we go forward. But we still see some significant growth here. Certainly in the Western United States, companies have their innovation spark on fire and really trying to grow as we go forward. Now, what does that mean from an origination perspective? You can see they're asking for a little bit more from an origination amount for the loans that are out there. Again, a little slower from a growth trajectory, but pretty level from an origination amount across all products. Utilization is creeping up. We're at about 32% across these types of companies as we go forward. Credit scores aren't coming down until we get up a little bit higher. But remember, we're kind of, as you said, in a little bit of a hunker down phase for the rest of the market. In professional scientific, we should see that continue to push forward, certainly as we continue to monitor policy changes, some of the shifts that we see across component and raw materials change over the next couple months. We're going to continue to watch that, certainly for this segment, to see if we can continue to get some growth. This is really where we see a lot of growth over the next couple years continuing in this segment. So we're going to watch, and if some of you are participating in this, suppliers, using the end products, it's an exciting time to be in artificial intelligence and with some of these tech companies as they start to expand their capabilities. All right, so one of the other things that I looked at, but let's talk about artificial intelligence, then I'll jump into one more thing. So when you think about artificial intelligence, how are you engaging it? So do you use ChatGPT? Is it just, are you pushing it off and saying, hey, AI is not a big deal, it's just another thing, I'm not going to get into it, I'm not thinking about it? Are you getting into it in your personal life, playing with it? Is your business using it for things that are non-credit applications? Are you building marketing plans with it? Are you doing fraud reviews? Are you evaluating some of the ways in which your business is franchising, where you're going to put a new store? Are you using it in your underwriting process? So are you using it really for a decision? Interesting to see how many of you have gone that far in your use of artificial intelligence, some of these large language models as we go forward. Are you just using all of the above? Like, have you gotten to a place where you are deploying these products and it really feels like it's impacting your business? All right, so let's see across this group, how much are we engaging AI? All right, Gary, how are we doing?
Okay, I see him coming in, just crossing the 50% voted. Now, it could be a fair portion that are not using it and don't want to participate in the poll. We'll see.
Okay.
We can see here, though, that on the business side, let me share this. On the business using non-credit applications, surprisingly, in the lead.
That is fantastic. So I think that's really a good position to be in. And as we're evaluating, certainly the error rate that comes from the Gen AI tools as we go forward, you look at ways that you can get it out there, maybe not in a credit decision, but you're looking for an opportunity to enhance or augment some of the processes that you're using. So I really think that's great, and I'm encouraged to see that so many of you are leaning into that. Now, one thing I will say as we're kind of going into this, there were some questions before about healthcare. We are seeing healthcare companies, again, a little slow in originations as we came into 2025. So again, a little slower. We saw some pressure that was put on by the administration on pharma, certainly on costs and expansion. So we'll continue to watch that through the summer. Delinquency rates really haven't gone up. They've actually come down in the 60 to 90 range. We've even seen 1 to 30 come down. Now the 30 to 60 is a little bit of slow pay. From a healthcare perspective, we've seen that go up a little bit, but we'll continue to monitor as we go forward. Certainly for healthcare providers and systems, we want to watch that. A lot of supply chains feed into that. A lot of small businesses are part of that ecosystem. So we'll continue to watch. Now that plays into our small business index. So when we think about the index, it's a little different than normal. So a small business index, it looks at, from an Experian perspective, it is, and Gary, we'll go back one, but the small business index, what it does is it's taking hard data that we find within our Experian ecosystem, and it looks at, it's not a survey. Now you'll see others that are out there that look at survey of small business health. What the Experian Small Business Index does is it looks at the hard data that we have furnished from third-party sources into Experian, and we look at not only the business, but the owner. And so it's blending those two together to get a health look at not consumer separate from business, but saying, how is this business owner engaging? How are they engaging with their business? Are they able, how fast does it take them to get a loan? Are they able to get a loan at a rate? Are they getting approved for it? And it looks across the whole US. Now you can use this QR code and get to the website. It's going to take you to some free information, show you at a state, by industry, how different industries are performing, the health of those industries and their owners of these businesses. But we've actually seen this tick up and down over the past couple months, down a little bit this month, but leveling out from where we were in our hardest dip toward the end of the year. So lending is still open, a little tighter than it's been before, but still in a very positive perspective. We see inquiries down just a little bit, but what you're going to see is utilization. Remember, it was below that 33% mark, and we're still seeing revolving and balances past due lower than would create some downward pressure on credit availability as we go forward. So very positive. And we'll hope to watch this and see it continue to move upward over the next couple months. All right, so let's go to our next slide, Gary, and we'll kind of get down to the final here. So remember, why do we do this? We do it because we want to make small businesses more visible. You can see that we looked at some of the fringe companies today. We said, all right, here's what the big ones are doing. We're looking at disposable income. We want to make these more visible, get them in a small business credit score, bring up both their consumer and commercial score, and that makes our US ecosystem even more strong. So that's our goal here at Experian. Now let's wrap it up a little bit from our talk track today. So from what we're seeing, pretty solid from a fundamentals perspective. Calls have been pretty strong from an earnings perspective. We're looking at regional resiliency, still pretty good. There are some regions that are a little more challenged than others. I encourage you to look at the Main Street Report that just came out. It goes into a little bit more of those regional trends. New policy impacts, we're going to see some of that, both foreign and domestic, continue to impact small businesses. Sentiment should pop back up here in the summer. We're looking for that. We already saw that with the Conference Board. We hope to see that with University of Michigan and the NFIB. And we're still seeing lenders holding steady, like you said, hunkering down for a little bit on their rates, but we should see some relief, hopefully, as we get a little bit more into the summer. So some volatility is still out there. We are still looking at some challenges over the next 6 months, but underneath the hood, everything still looks pretty stable. All right, Gary, where do you want to take us from here?
Excellent presentation today, Brody. I think we are just about out of time. There was one question that came in around the record number of business creation. Any thoughts on what's driving the number of new businesses that we're seeing created, and are we seeing much in terms of business closure at this point?
Good question. So we are seeing business closures pick up, and a lot of that is picking up in some of our construction where we have some heavy turn, and in retail. So you'll see those where you have big ones, and retail, online retail has really been a big push that we've seen in the southern states as where businesses are opening the most. Easy to do. You can do it with ChatGPT, open up your business really quick. You can open a business in 30 minutes and be up and running, filing your Secretary of State, and getting your business documents together. So it's pretty quick to do. Lots of opportunity to sell your wares and become visible in the market. And so it's just a good time to start a business. And a lot of people are doing it kind of as a side hustle, especially as we get into some volatile times, to supplement their income. So we'll continue to see this trend through the next 2 years or so, maybe even beyond. This could be the new norm, and it really feels like it.
Excellent. And with that, we hope that today's review has lived up to your expectations. We've included a few comments from prior attendees here on screen and greatly appreciate your feedback after we conclude the webinar. So please complete your short exit survey. It really does help us continue to improve these quarterly reviews. And remember to check out our Commercial Insights Hub for more great insights on small business credit performance. If you would like to explore our commercial solutions and client case studies, visit experian.com/commercial. And we thank you for attending today. We will see you back here for our Q2 quarterly credit review in August. Everyone have a great summer. We'll talk to you soon.
Thank you.
Have a great day.